Unless you've been living under a rock lately, you're probably well aware that January stock performance for 2022 is worse than any other January on record. Concerns about inflation, rate hikes from the Fed, and the looming Russia-Ukraine conflict are three of the factors that are causing some extreme volatility in the market. And it's pretty much just been a massive roller coaster. For example, on the 24th, the DJIA, the Dow Jones, was down 3.3% since the previous day's close, but then staged a massive intraday recovery and ended the day 0.6% higher than the previous day's close. And much of this volatility was exacerbated as we got closer and closer to the 25th and 26th when the Fed was holding their meeting. Now hold on, I thought we were talking about real estate. We will. It's important to understand what's going on largely with the rest of the financial markets, and then we're going to be able to understand how that's going to impact real estate, and it's all going to tie in, I promise. Now like I said, there was a lot of concern about this Fed meeting on the 25th and 26th. Now despite popular belief, the Federal Reserve's job is not to make sure we have a booming stock market and that every meme investment or every crypto investment you make just goes to the moon. The Federal Reserve is the central bank, and their job is to oversee the economy, regulate financial institutions, and control the supply of money. And over everything else, the Fed's job is to make sure that we've reached maximum levels of employment, they control inflation, and that we have a strong labor market. Now back in 2020, because of fears that the entire market was going to collapse, the Fed reduced rates down to 0% in order to incentivize spending and boost the economy. And in order to do so, the Fed had to initiate quantitative easing, which is when they start buying bonds, treasuries, and other mortgage-backed securities. And if you're wondering how come you bought a new car or a new house and you didn't get a 0% loan, well that's because the rate that the Fed reduced down to 0 is the federal fund rate. And the federal fund rate is the interest rate that is paid between banks. And banks are often sending each other money back and forth to satisfy their cash on hand requirements. But since 2020, as you probably noticed, other interest rates like mortgage rates have decreased significantly as well. And that's just because as banks are able to borrow money at a cheaper rate, they're able to pass on those savings to you and you get a cheaper rate as well. But now with how well the economy has been doing since 2020, the Fed announced back in November that they would be tapering their $120 billion a month bond purchases and that they will stop adding to their bond portfolio by March of 2022. And tapering is how the Federal Reserve throttles back its economic stimulus by slowing the pace of its asset purchases. So tapering is basically a way to phase out quantitative easing while still helping economic recovery. And with this Fed meeting in late January, a lot of people were concerned that Jerome Powell was going to initiate a couple rate hikes earlier than expected. And even though there hasn't been a rate hike of more than 25 basis points since early 2000, there was concern that we were going to see a 50 basis point rate hike at the meeting. But to everyone's surprise, the Fed decided that they're going to keep their target rate for the federal fund rate between 0 and 0.25%. In other words, they're not increasing rate hikes more than expected, at least not for the time being, although we will start seeing rate hikes starting in March. And all of this meddling in the market is definitely not without its drawbacks. One of which is inflation, which is at a 40-year high and has a lot of people concerned that they're going to be priced out of buying a house, buying a car, or even uncooked roast beef. And over the last 2 years, we've seen the prices of pretty much every asset class and every alternative asset class increase dramatically. We've seen homes sell for $1 million over asking price. We saw a $50,000 Patek sell for 130 times more than its list price. We've seen photos of monkeys sell for millions of dollars. We've seen a 30% increase in used cars. We've seen all-time highs in the stock market and the crypto market as well. And this has a lot of people thinking that we're in an everything bubble. And whether or not we're going to see a stock market crash or a crypto crash later this year, I don't know. I don't predict the future. But I don't think we're going to have a real estate crash in 2022. And here's why. But first, understand what I mean by real estate crash. I do not expect to see 40% depreciation in home values like we saw in 08 and 09. We just don't have the same issues that we had back then. Back in 2008, we were having collateralized debt obligations, or CDOs, which are basically just a bunch of mortgages all packed together into one package that you can purchase. They were receiving AAA ratings, and in all reality, some of them should have been receiving the same ratings as junk bonds. And when you combine all of that with the issues from predatory lending practices and credit default swaps, we had a massive crash, obviously. So thankfully, we don't have those issues today. Now, the median home price in the United States was $322,000 in Q2 of 2020. And since then, it has risen almost $100,000 to $411,000 in Q3 of 2021. That's about a 30% price increase in just 15 months. But we're already seeing prices adjust slightly because in Q4 of 2021, the average sales price came down to about $408,000. And I know that's hardly even a percent change, but I expect once we get the data for Q1 of 2022, we're going to see even more leveling off of prices. And part of that is going to be due to the mortgage rate increases which we've seen since the start of this year. The average 30-year mortgage rate increased to 3.63%, which is the highest that we've seen since 2020. Typically, mortgage rates and home prices can have an inverse relationship. And this isn't always true because sometimes we do see high home prices and high interest rates. But oftentimes as mortgage rates goes up, that causes negative pressure on home prices, and so we see home prices start to fall. And the simple reason for this is because if home prices are high and mortgage rates are high, then the average buyer can really quickly become priced out of the market. And in that situation, if sellers want to sell their house, they're gonna have to lower the price of their home in order to get access to a new pool of buyers. But don't get too excited thinking that you're gonna save a ton of money on your home because of these interest rate hikes. And that's because 1% increase in rates will decrease your buying power by about 11%. That means if the average interest rate goes up 1% and the average home price goes down 10%, then you're gonna be still paying the same amount of money per month, you're just gonna be paying more to the bank. And nobody wants that. So that's factor number one. We're having interest rate increases which should put some pressure on home prices, and maybe we'll see those come down a bit, or at least cool off. And the second factor is the supply chain issues that we're still having. We still have a chip shortage and a shortage in raw materials, and that's gonna impact the speed at which homes are being built and the affordability of those homes. Which brings us to the number one reason why I do not think we're gonna see a real estate crash in 2022, not even close. Lack of inventory. We saw record low inventory of homes back in 2020 when we only had 3.5 months supply on the market, and the average or typical range is 6 months supply, so we are about 50% less than usual. And while the average US market has recovered, in some states like Texas, Florida, Utah, Idaho, we're still seeing record low inventory levels in the 2 or 3 months range, and in some popular neighborhoods, sometimes even less than a month. And a big reason for this is we just don't have enough houses. The rate at which we're building homes is the slowest it's been since 1995. We're 5 million homes short, and it doesn't look like we're gonna be making up that difference anytime soon because that gap is getting wider. A lot of people point to 2020 as the reason why we don't have enough inventory on the market. We've actually been underbuilding for about a decade, but with the shutdowns in 2020 and the supply chain issues that resulted, the home inventory issues just increased exponentially. And according to the Census Bureau, 1.3 million homes were completed in 2022. And in order to make up for the 5 million homes that were short in inventory, you have to build about 2.1 million homes per year for the next decade to be at equilibrium. So despite what the financial markets and the crypto market does in 2022, I do not see the real estate market crashing like it did in 2008, not even close. The housing market was the cause of the crash in 2008. But in 2022, lack of inventory is the reason why demand and prices are just so sky high on the average house. It's not because people just want to pay more money for a house. It's because there's not enough homes to go around, and so you have to pay a premium in order to get one. And unless we start building significantly more homes, I don't see this inventory issue going away anytime soon. And instead of seeing a real estate crash in 2022, what I expect to see is just a decrease in the appreciation that we've been seeing year over year. Depending on what forecast that you read, you can expect anywhere between 3 and 8% appreciation for real estate prices this year. Only time will tell what real estate prices are going to do in 2022, but I don't expect to see that 30% year over year appreciation this year, probably somewhere more in the 7 to 8%, at least matching inflation.